$650 billion vanished in 70 minutes. Not from stocks, not from crypto, from silver. On December 29th, 2025, silver crashed from an all-time high of $83.75 to $75.15 in just over an hour. But here's what should keep you up at night. While Western traders were liquidating positions in panic, Chinese buyers were still paying $89 per ounce for the exact same metal. Let me say that again. The same silver, two completely different prices. An $8 premium that had never been seen before. What just happened? And more importantly, what does this tell us about what's coming in 2026? This wasn't just a crash. This was a warning shot. Let's start with what actually happened Monday morning, December 29th. Silver opened Asian trading and immediately rocketed to a new record of $83.63 per ounce. For context, just 1 year ago, silver was trading around $20. In 12 months, it had nearly tripled. Then, in the span of breakfast, $4 billion in silver positions were vaporized. Traders watching their screens described it as prices teleporting lower as bids completely disappeared. One analyst wrote that liquidity vanished entirely during the drop. But before we explain why this happened, you need to understand something crucial. This crash occurred after silver had delivered one of the greatest rallies in modern financial history. Silver gained 148% in 2025. That's not a typo. 148%. It outperformed gold, the S&P 500, even most cryptocurrencies. At its peak, silver's market capitalization briefly surpassed Nvidia, one of the world's most valuable tech companies. This wasn't some obscure commodity having a moment. This was a global financial event. And the reason it crashed so violently tells you everything about what's actually happening beneath the surface of our financial system. So what triggered the collapse? The immediate catalyst was a margin call crisis. The CME, the Chicago Mercantile Exchange, where silver futures are traded, announced a dramatic increase in margin requirements effective after market close on December 29th. For those unfamiliar, margin requirements are essentially the collateral traders must put up to hold leveraged positions. When the CME raises these requirements during a massive rally, it forces traders to either deposit more cash immediately or liquidate their positions. With thin holiday trading volumes and positions that had become massively profitable but equally leveraged, many traders had no choice but to sell. And when everyone tries to exit through the same door at once, prices don't just fall, they crater. But here's where it gets interesting. While Western paper markets were imploding, physical silver in China was trading at a massive premium. The Shanghai Gold Exchange showed spot silver prices above $89 per ounce, an $8 premium over London prices. This was the largest physical premium on record. Think about what this means. In the world of paper contracts, futures, and financial derivatives, silver was crashing. But in the world of actual physical metal, the kind you can hold in your hand, Chinese buyers were bidding aggressively, willing to pay significantly more than the global benchmark price. This wasn't confusion. This was a signal. China's demand for physical silver has been exploding, driven primarily by industrial consumption. In 2025, Chinese financial news sites were buzzing with reports of a global silver shortage, particularly related to the photovoltaic industry, which uses silver extensively in solar panels. Since 2021, solar energy has become a major driver of silver demand, and China dominates global solar panel production. Despite manufacturers working to reduce the amount of silver used per panel, the sheer scale of solar installations means industrial demand remains robust. When physical metal is trapped in the wrong location or the wrong form, premiums spike. That $8 premium in Shanghai tells us physical silver was tight, very tight, and buyers were scrambling to secure deliverable metal. Now let's zoom out and look at the bigger picture, because this crash is really just a symptom of something much larger. The silver market has been in a structural deficit for 5 consecutive years. In 2025 alone, global demand reached approximately 1.24 billion ounces, while total supply, including mine production and recycling, only provided about 1.01 billion ounces. That's a deficit of over 230 million ounces, equivalent to the entire annual output of Mexico, the world's largest silver producer. Let me put that in perspective. Imagine if every single ounce of silver Mexico produced this year simply disappeared. That's the size of the supply gap we're dealing with. Why can't miners just produce more? Here's the problem. Silver is primarily a byproduct of other metal mining, especially copper, zinc, and lead. Miners aren't digging for silver specifically, they're mining base metals, and silver just comes along for the ride. This means even if silver prices double, miners can't simply flip a switch and produce more. Their operations are driven by base metal economics, not precious metal prices. And starting a new mining project, that takes 8 to 12 years to develop, requires billions in capital, and faces increasing regulatory hurdles globally. Meanwhile, ore grades are declining. meaning miners have to dig through more rock to find the same amount of silver. This structural deficit has been quietly eroding inventories around the world. London vaults, historically a major storage hub, have seen significant outflows as metal moves to meet demand in Asia. Lease rates, the cost to borrow silver, hit record highs in 2025. 1-month silver lease rates reached 6.6%, historically elevated, and a clear sign that available supply is extremely tight. When borrowing costs are that high, it signals market participants are desperate for physical metal and willing to pay premium rates to access it. Industrial demand continues to hit new records. In 2025, industrial fabrication was forecast to surpass 700 million ounces for the first time in history, growing 3% despite economic headwinds. Silver is essential in green economy applications like solar panels, electric vehicles, and charging infrastructure. It's used in semiconductors, 5G networks, and medical equipment. Unlike gold, which is primarily a store of value in jewelry, silver is consumed in industrial processes. Once it's used in a solar panel or electronic device, it's essentially gone. This consumption dynamic creates persistent demand that doesn't disappear when prices rise. But there's another layer to this story that most people miss. Investment demand is surging. Silver ETFs, exchange-traded funds that hold physical silver, saw inflows of 187 million ounces in 2025. That's institutional and retail investors voting with real money that silver belongs in their portfolios. Why? Because in an environment of persistent inflation, ballooning government debt, and unprecedented currency creation, hard assets like silver offer protection. Gold has been getting most of the headlines, hitting over $4,500 per ounce before its recent pullback. But silver has a unique profile. It's both an industrial metal and a monetary metal. It benefits from the same macroeconomic factors driving gold higher, but also from the structural demand of the green energy transition. Central banks around the world have been accumulating gold at record levels, over 1,000 tons annually since 2022. This de-dollarization trend signals a global realignment away from US dollar reserves toward hard assets. While central banks primarily buy gold, the shift in sentiment toward precious metals broadly creates a halo effect for silver. Investors increasingly view silver as a hedge against currency debasement and a store of value in uncertain times. Now, here's where things get really interesting for 2026. Let's think through 3 scenarios. Scenario 1, consolidation and recovery. In this base case, silver consolidates between $70 and $80 for the first half of 2026. The extreme leverage that caused the December crash gets cleared out. Markets stabilize. Industrial demand remains strong as solar installations hit another record year globally. Investment demand continues, but at a slower pace than the frenetic 2025 rally. Mine production increases slightly, maybe 2%, but nowhere near enough to close the supply deficit. In this scenario, by the end of 2026, silver tests $90 to $100 per ounce as the structural deficit reasserts itself, and investors realize the December crash was just profit-taking, not a fundamental breakdown. Scenario 2, the squeeze intensifies. This is the bull case, and it has maybe a 30% probability. Here's how it plays out. The physical supply situation in China doesn't improve. Shanghai premiums remain elevated. Industrial demand exceeds forecasts as AI-driven power demand accelerates grid infrastructure build-out and solar installations surge beyond expectations. Investment flows into silver ETFs accelerate as Western investors realize they're dramatically underallocated to precious metals compared to historical norms. Central bank gold buying remains robust, keeping the precious metals complex bid. In this scenario, silver breaks through $100 by mid-2026 and targets $120 to $150 by year-end. Several major mining analysts, including those from BNP Paribas, have suggested $100 silver is viable by end of 2026, given the supply-demand fundamentals. If physical tightness persists and investment demand accelerates, higher prices become necessary to ration supply and incentivize new production. Scenario 3, the correction deepens. This is the bear case with maybe a 20% probability. Trade tensions escalate significantly, global economic growth slows materially, and industrial demand softens. China's economy disappoints further, reducing both industrial consumption and investment demand. The dollar stages a sustained rally, making dollar-denominated commodities like silver less attractive. Silver corrects back to the $55 to $65 range. Even in this bearish scenario, though, notice the price is still double where it started 2025. The structural deficit persists, just with weaker incremental demand. This would likely set up an even stronger rally once economic conditions stabilize, as the supply deficit would continue growing. Here's my base case. Silver likely consolidates near current levels through January and February, finding support around $70 to $75. As markets digest the leverage flush out from late December, investors will focus on the fundamentals. Those fundamentals are stark. 5 years of structural deficits, record industrial demand, extremely tight physical markets, limited new supply coming online. By the second half of 2026, I expect silver to challenge $99 and potentially break through $100 if investment demand remains strong. But there's something else we need to discuss. The Shanghai premium is a canary in the coal mine. When physical metal trades at an $8 premium to paper markets, it tells you something fundamental about price discovery. For decades, precious metals prices have been set in Western paper markets, futures exchanges, and derivative contracts. But what happens when the physical metal concentrates in the East? What happens when Chinese industrial buyers, Indian retail investors, and Asian central banks become the marginal price setters? You get disconnects like we saw on December 29th. And these disconnects tend to resolve not by physical prices falling to meet paper, but by paper prices rising to meet physical. The Western financial system runs on leverage and derivatives. The physical metals market runs on supply and demand. When these two worlds diverge, history suggests the physical market ultimately wins. It just takes time. Let's talk about what this means for you. If you're watching this video, you're probably wondering, should I buy silver right now? Should I wait for a pullback? What's the right allocation? I'm not a financial advisor, so I can't tell you what to do, but I can share how to think about this. First, understand silver's volatility. That 148% gain in 2025. That came with violent daily swings, including the 10% crash we just witnessed. If you can't stomach 20% to 30% drawdowns, silver isn't for you. This isn't a stable asset. It's a volatile commodity with monetary characteristics. Second, think about allocation. Most financial advisors suggest precious metals should represent 5% to 10% of a diversified portfolio. Within that allocation, many split between gold and silver. Gold tends to be less volatile and better for wealth preservation. Silver offers more upside potential, but with significantly higher volatility. A reasonable approach might be 60% gold, 40% silver within your precious metals allocation. Third, consider physical versus paper. You can buy physical silver coins and bars, or you can buy silver ETFs that hold physical metal. Physical gives you direct ownership, but comes with storage and insurance costs. ETFs offer liquidity and ease of trading, but are paper claims on metal. The Shanghai Premium teaches us that physical ownership matters, especially during market stress. If you're buying for long-term protection, physical makes sense. If you're trading around price movements, ETFs offer better execution. Fourth, understand the timeline. The structural deficit story plays out over years, not months. Dollar cost averaging into silver over time, rather than trying to time the perfect entry, makes sense for most people. Markets can remain irrational longer than you can remain solvent, as the saying goes. Even with compelling fundamentals, silver could consolidate or correct before the next leg higher. Fifth, watch the key indicators: Shanghai premiums, silver lease rates, ETF flows, mine production data. These data points tell you about physical market tightness and investor demand. When premiums stay elevated and lease rates remain high, it confirms supply is genuinely tight. When ETF inflows accelerate, it signals institutional conviction. These aren't perfect predictors, but they're valuable gauges of market stress. The biggest takeaway from the December 29th silver crash isn't the crash itself, it's what the crash revealed. We're in a market where demand structurally exceeds supply, where physical tightness is creating record premiums, where leverage can cause violent price swings, but underlying fundamentals remain robust. This is the setup for a multi-year bull market, with all the volatility and opportunity that entails. Looking ahead to 2026, several major themes will drive silver. The green energy transition continues accelerating, consuming hundreds of millions of ounces annually. Global debt levels keep rising, supporting precious metals as hedges against currency debasement. Geopolitical uncertainty remains elevated, driving safe haven demand. Mine supply growth stays constrained, unable to close the deficit gap. And critically, more investors are waking up to silver's dual nature as both an industrial and monetary metal. The silver market in 2026 will likely be defined by continued volatility, persistent supply deficits, and the slow realization among mainstream investors that this isn't just another commodity rally. This is a fundamental repricing of a critical metal that's been systematically undervalued for decades. When you mine less than you consume for 5 straight years, eventually price has to rise enough to either ration demand or incentivize new supply. We're in that process right now. Here's what I'll be watching closely. First, Chinese physical premiums. If they stay elevated above $5 per ounce, it confirms the shortage is real and persistent. Second, silver lease rates. If they remain above 4%, it signals continued tightness in available supply. Third, ETF flows. If Western investors continue accumulating at the pace of late 2025, it adds significant demand. Fourth, mine production data. Any disappointments in output forecasts would tighten the market further. And fifth, the gold to silver ratio. Historically, silver outperforms gold during precious metals bull markets, meaning the ratio declines. If we see the ratio drop toward 50 or below, it suggests silver is in the early stages of dramatic outperformance. The December crash shook out weak hands and cleared excessive leverage. That's actually healthy for the market long term. Markets that rally without corrections often face more severe crashes later. The December flush reset positioning and created a cleaner technical setup for the next leg higher. Many commodities analysts compare the current silver market to the late 1970s, when persistent supply deficits and high inflation drove silver from $6 in 1976 to $50 by 1980. We're not predicting a repeat, but the fundamental setup shares similarities: supply constraints, monetary uncertainty, and structural demand growth. One final thought about the Shanghai premium. For decades, London has been the global benchmark for precious metals pricing, but as wealth and industrial demand shift east, is it possible that price discovery shifts too? Chinese demand, both industrial and investment, is increasingly setting the marginal price for silver. Indian retail demand, particularly for physical silver, has surged as local prices rise. When Eastern physical markets trade at sustained premiums to Western paper markets, it forces a rethink of where true price discovery happens. This isn't about manipulation or conspiracy. It's about where the actual metal needs to be versus where derivative contracts say it should trade. The fragmentation we're seeing between physical and paper markets could be the defining characteristic of precious metals in the coming years. And in that fragmented world, owning claims to physical metal, whether through allocated storage or direct ownership, becomes increasingly important. The price you see on a futures screen might not be the price you can actually obtain physical delivery at. That spread, that premium, is real cost, and it's telling you something fundamental about supply and demand. So where does this leave us? Silver at 70 plus is higher than most investors ever imagined possible. But against a backdrop of 5 consecutive years of supply deficits, record industrial demand, and structural constraints on new production, is it expensive? Or is it finally reflecting its true value in an economy that desperately needs it? The market will answer that question through 2026. What we know is this: the crash of December 29th cleared out excess leverage, revealed extreme physical tightness in Asian markets, and set the stage for the next phase of silver's multi-year rally. If you found this analysis valuable, consider subscribing. We're going to be tracking these precious metals markets closely through 2026, because whether you own silver or not, what happens in this market tells you something crucial about our broader financial system. When physical assets trade at massive premiums to paper contracts, when supply deficits persist for years, when central banks accumulate record amounts of hard assets, these are signals worth paying attention to. Thanks for watching, and I'll see you in the next one.